Today we're diving into Ben Carlson's insightful article, Misbehaving in a Volatile Market, exploring how behavioral biases impact investment decisions, especially during market turbulence. It's a topic that resonates deeply with investors of all levels.
Absolutely. Volatility amplifies our inherent biases, leading to decisions we often regret later. Understanding these biases is crucial for navigating uncertain markets.
Precisely. The article highlights several key biases. Let's start with recency bias. How did that manifest in volatile markets?
Recency bias makes us overweight recent events. A string of market gains leads to overconfidence, while losses fuel excessive pessimism. We tend to extrapolate recent trends, ignoring the long-term perspective.
So essentially we become overly optimistic or pessimistic based on short-term market movements?
Exactly, and that ties directly into loss aversion, arguably the most significant bias in finance. Losses feel far more painful than equivalent gains feel good. A 10% drop feels worse than a 10% rise.
That's a powerful point. This emotional response can lead to impulsive decisions, right? Selling low and buying high, the opposite of what we should be doing.
Precisely. The emotional pain of losses often overrides rational decision-making. Frequent portfolio checking exacerbates this, as we're constantly bombarded with potentially negative information.
Let's move on to confirmation bias. How does the readily available information online influence our investment choices?
The internet makes it incredibly easy to find information confirming our existing beliefs. If we're bullish, we seek bullish news. If bearish, we find bearish news. This selective exposure reinforces our biases and prevents objective evaluation.
And anchoring, how does that affect our decisions during market volatility?
Anchoring involves clinging to specific price points, like a stock's purchase price or all-time high. This can prevent us from making rational buy or sell decisions based on current market conditions. We might hold on to a losing stock too long, hoping to break even, or miss buying opportunities because the price is above our anchor.
The article also mentions hindsight bias. How does that play a role?
Hindsight bias is the I knew it all along effect. After a market event, we tend to believe we could have predicted it even if we couldn't at the time. This false sense of foresight can lead to overconfidence and poor future decisions.
And what about endowment bias?
Endowment bias makes us overvalue what we own. We tend to believe our investments are worth more simply because we own them, making it difficult to sell even when it's rational to do so.
Finally, the gambler's fallacy. How does that relate to investing?
The gambler's fallacy is the belief that past events influence future independent events. For example, believing a market downturn necessitates an immediate rebound. While momentum exists, short-term market movements are largely random.
The article also discusses the illusion of control. Can you elaborate on that?
The illusion of control is the belief that we can influence uncontrollable outcomes. In investing, this might lead to excessive trading during downturns, believing we can time the market, which often leads to worse results.
And the sunk cost fallacy.
The sunk cost fallacy is the tendency to continue holding on to investments simply because we've already invested in them, regardless of their current value or future prospects. We justify holding on to losing investments because of the money already spent.
These biases are all interconnected, aren't they?
Absolutely. They reinforce each other, creating a cycle of poor decision-making. Recency bias can lead to overconfidence, fueling confirmation bias, and the illusion of control.
So how can investors mitigate these biases?
A well-defined investment plan is crucial. It provides a framework for making rational decisions regardless of market fluctuations. Sticking to the plan helps avoid impulsive actions driven by emotions and biases.
The article mentions that the worst bias is often the one we fail to recognize in ourselves. How can we improve self-awareness?
Regular self-reflection is key. Analyzing past investment decisions, identifying potential biases, and learning from mistakes can help improve self-awareness. Seeking feedback from trusted advisors can also be beneficial.
It's about recognizing our own vulnerabilities and developing strategies to counteract them.
Absolutely. A long-term perspective is essential. Focusing on the long-term goals rather than short-term market fluctuations helps maintain discipline and avoid emotional decision-making.
So it's about emotional intelligence as much as financial knowledge?
Precisely. Understanding our own emotional responses to market volatility is just as important as understanding financial markets themselves.
The article suggests that dollar cost averaging can help mitigate some of these biases. What are your thoughts on that?
Dollar cost averaging is a great strategy for mitigating emotional decision-making. By investing a fixed amount at regular intervals, you avoid trying to time the market, reducing the impact of short-term market fluctuations.
It's a disciplined approach that helps to smooth out the emotional roller coaster of investing.
Absolutely. And for many investors, seeking professional advice can be invaluable. A financial advisor can provide objective guidance, helping to navigate emotional biases and stick to a well-defined investment plan.
That's a crucial point. A fresh perspective can be incredibly helpful in making rational decisions. The article emphasizes the importance of continuous learning. How can investors stay informed and adapt to changing market conditions?
Staying informed is crucial, but it's important to be discerning about the information we consume. Focus on reputable sources and avoid getting caught up in the noise and speculation that often accompanies market volatility.
It's about finding a balance between staying informed and avoiding information overload.
Market volatility is inevitable. Understanding our own behavioral biases and developing strategies to mitigate their impact is crucial for long-term investment success. It's a continuous process of learning and self-improvement.
It's about developing emotional resilience and maintaining a long-term perspective, even when markets are turbulent. This has been a fascinating discussion. Thank you for sharing your expertise and insights on navigating the challenges of volatile markets. Your perspective on the role of behavioral biases is invaluable for investors.
Thank you for having me.